Hello, and a very warm welcome to our first ever ElysianNxt Podcast. I am Chris, the CEO and founder of ElysianNxt, and I'm joined in Bangkok in the studio today by Katherine Natividad, Senior Consultant at RegCentric, and via video link from Sydney by Thomas Verlaet, Founder and Principal at RegCentric. RegCentric partnered with ElysianNxt to help financial firms in their regulatory compliance. And today we're going to discuss a very interesting topic about regulatory compliance. We will discuss the Basel IV standards and specifically the part of the credit risk and the RWA calculations. While Europe has delayed the introduction of those new standards from 23 to 25, in Australia, APRA stuck to its image of one of the strictest regulators in the world and kept going with the original implementation deadline of 1st January 23. So there's a lot of things that we can learn from how firms within Australia are preparing to become compliant with the new Basel IV guidelines. We will discuss about the challenges, the potential business implications, the partnership between RegCentric and ElysianNxt, and much more. Katherine and Thomas, thank you for joining me. Thomas, can you maybe quickly introduce RegCentric?
Yeah, sure. Thanks, Chris, and thanks for having us. So RegCentric is a consulting firm, Australia-based, specialized in finance, risk, and regulatory reporting. Our background is a combination of people coming from industry directly, but also from the regulator, APRA, as well as from software vendors. So we've brought a team of fairly senior people together to help Australian banks and credit unions address their regulatory obligations as efficiently as possible, and actually to derive strategic transformational outcomes as part of their uplifts in their regulatory environments as well.
Mm-hmm. With the implementation not too far off from now, what do you see as main challenges that firms within Australia had to deal with becoming Basel IV compliant?
I'll take that one first, maybe, Kathy, and then you can jump in and add to it. Look, I think Australia is not unlike in other countries. We have a very wide range of firms in Australia. We have a number of very advanced and big organizations, often referred to as the Big Four banks in Australia. They are IRB accredited. They have very advanced credit risk modeling capabilities. Their problems or their challenges and their solutions are probably a little bit different to what the smaller end of town would be looking at. And we do have a fairly big amount of small entities as well in Australia. So we have credit unions and small banks, small ADIs, we call them here in Australia as well. When you look at the different components of Basel IV, thinking about technology, process, people, business implications, the implications are different for those different types of institutions. So if you look at the bigger end of town, the big banks with their IRB models, really one of their key challenges with a Basel IV implementation is that almost all of them are still on very kind of older technology. So, they would have implemented a Basel II engine or built their own internal solution for Basel II compliance. And, you're looking at technology architectures that are 15, 20 years old or older, and technology has kind of significantly moved on since then. So we see a lot of organizations in Australia take a very strategic approach and go through large scale transformation of their Basel credit risk engines, with this reform. So, the majority of our Big Four banks have started quite a few years ago on transforming their back office systems effectively for their calculations and moving away from the monolithic legacy infrastructure and calculators to a more microservices-based oriented architecture with much more fast and intraday and maybe on-demand calculations. And effectively from a requirement side, from a modeling side, the change for them is not, as significant as it is for smaller banks who are on the standardized approach. The biggest change for them is actually they also need to do the standardized approach in order to satisfy the requirements to look at the floor of standardized versus advanced. So their calculations and their engines are now being stood up to also do the standardized calculations next to the internal rating-based approach. If you look at the smaller end of town, the credit unions and smaller banks, many of them historically have been able to do their capital adequacy calculations and reporting on spreadsheets or on tactical solutions. And so for them, the opportunity is to really look at this as an opportunity to improve their end-to-end process, not just from a calculation, but also from a disclosure and a reporting perspective. So the challenges are slightly different. The solutions are slightly different depending on the size of the organization. Do you have anything to add to that, Kathy?
Yeah, it's a very good point, Thomas. And you did mention that the standardized approach is something that both the big banks and the smaller banks are actually affected by. And one of the things that become common across all banks, regardless of size, is their requirement for more granular data. So because the regulation is now it's actually asking for more details, it's a bit more risk sensitive. Mm-hmm. So for example, the introduction of the concept of standard versus standard loans, where now banks would have to look at, say, their LVR ranges, performance of loans in the past 36 months, things like level of documentation, serviceability, enforceability. Some of these things they did not really take into account before, just because it's probably was not necessary in terms of their regular process or in the origination process. But in the realm of the new Basel requirements, all of these are required because they have an impact ultimately on the risk weights assigned to each asset. So inadvertently, if you don't have all of those values, that granular data, you might actually have a higher risk-weighted asset, which would have an impact on your overall capital adequacy. And that's what you want to really monitor as part of Basel, which is ultimately what the Basel standards is about. Mm-hmm. They want banks to really have a look at their data on a deeper level and have a better understanding of the performance and ultimately the risk of their portfolio. So that granular data requirement aspect is really a big challenge because a lot of the banks are not really recording a lot of these information to begin with. So they would either try to infer the data from what they currently have now, and also potentially have a relook at their origination process and collect the data earlier at source before it becomes a problem later on towards the regulatory reporting side. Mm-hmm. So I think that's like one of the biggest things that we're seeing everyone struggling with a bit now, even before they go to the reporting side, just figuring out if they have all of the data that they need and what are the data gap mitigation processes that they need to implement in order to get all of those valuable information in.
Mm-hmm. Now, picking up on what you say about gathering more data, a more granular level of data, are the smaller firms in Australia, ready to do that? Mm. Given that the deadline is just around the corner, so to speak?
Yeah, it's a good question. So a lot of the clients that we are speaking to, and we're seeing it in the market as well, that they first started with really fully understanding the regulations first, and the impact, what type of products, what type of their different portfolio that would be impacted by the regulation. and then start to have a look at the data gap analysis, meaning what data do they have and what they don't have. And we're seeing that there's now a lot of work being done to basically plug in the information that was not collected previously. So, there are clients who are looking at getting help in terms of coming up with improved, say, data queries or interpretation of the regulation to kind of understand, okay, what does this definition actually mean for us in terms of data? So there's a lot of things like exercises like that happening at the moment. So I think it's fair to say that everyone would be impacted by it. Not everyone at this point would have all of the data ready for Basel IV perfectly in its perfect format.
Yeah, understand. Now, when we're talking about risk-weighted assets and capital allocation, it's important for a bank. I mean, that's what drives the business. So, do you see any kind of important business implications of what's happening under the new framework? Thomas, what's your view on that?
Yeah, absolutely, Chris. And I think that's maybe one of the lessons learned that we can take away from Australia is that this isn't just a regulatory program. I mean, like you said, the capital allocation, return on capital is at the end of the day one of the core metrics, one of the core performance indicators of any organization. And if regulators start tweaking the rules, then the actual return on those capital allocations actually changes. So, yeah, absolutely. There's significant business implications. There are parts of the portfolio that may prove to no longer be viable. We've actually had a number of examples with clients where, going through the rules, they basically deem certain parts of their portfolio to be no longer competitive because of the requirement to hold significantly more capital. Also on the flip side, there are areas within the standard where there are capital savings to be made, and there's definitely opportunity to be more capital efficient in certain areas and certain pockets of the book, and to increase investment in those areas and in those products and those customer cohorts. So absolutely, lots of opportunities under the new framework to improve capital efficiency, and early engagement of those business stakeholders is really critical. It is an observation that in a lot of organizations, when you look at finance, or when you talk about Basel IV implementation, it's a finance risk lens that's been put up over it. It's a very kind of regulatory reporting approach, and those organizations really miss out on the opportunity to really look at this as from a transformational lens and look at the opportunities that come with reg change. And so early engagement and education effectively of the business stakeholders, and bringing them on board from the beginning and looking at the implications together. It actually drives two things. That first of all, they're much more engaged, and quite often you need those stakeholders to be involved in the project. They need to provide data. Often they're data custodians of the systems that house the data. So you need to often work with them anyway on the project to get what you need to get to the compliance side. If you've engaged them early and you've engaged them when you look at the benefits they can get out of the reg change and the reg reform, they get much more on board with the whole journey you're going on, and they actually see the benefit of providing good quality data, for example, and making potentially systems improvements to get better and more granular data, which could actually lead to better capital outcome and ultimately for them a better a better position from a capital consumption perspective, and therefore a better performance of their business unit or of their products. There's definitely a lot of impact on business, on product, on portfolio allocation, and engaging with your stakeholders early and bringing them on the journey is definitely worthwhile.
Mm-hmm. No, that's a very good point that you're touching upon, is that I think firms can leverage of the investments that are going into these programs, given all the different stakeholders involved, given the implication on the business, given the requirement to gather more data, the calculations, and so on. Is there any regulation, particularly in Australia, that you can say, well, banks could benefit from this with what the firms are doing within the Basel IV framework?
Well, there's actually quite a few that come to mind, Chris. APRA, as many regulators across the world as well, is really on that journey of granular data collection. So even very recently, last week, APRA provided an update to the industry of their 5-year roadmap towards granular data collection. So this is an area that we very much see as an area where you can create synergies and strategic benefits by bringing your data together at the granular level, which you need for RWA computations anyway, and then leverage that as a single source of truth for wider reporting to the regulator, but also for internal reporting purposes, for your internal management information, your internal credit risk analytics, even your board reporting or your public disclosures can all feed off that granular trusted data set that you create as part of these programs. Any other ones you can think of, Kathy?
I think ASB 9, for example, because it's basically has a lot of input on credit risk and mostly impacting your assets, so particularly loans. So ASB 9 is one of them, and it kind of all comes together within APS 220, which is the credit risk management requirement for APRA as well. That really, at the beginning, it started with really collecting data for both credit risk RWA and also IFRS 9 ECL calculations in one single view. But now APRA has kind of evolving the requirement a bit more in the past couple of months, and potentially the requirement might change a bit in terms of reporting standards, but the essence is still there, that essentially you would want to have capability to integrate your data, especially in the lens of credit risk, in a more holistic way, looking at both sides of the coin, which is ASB 9, which is more your internal management of your losses, versus Basel, which is more your regulatory driven view of what to report against your risk and ultimately potential losses. So being able to manage both while having kind of the same underlying data as source is really something that I think banks should have a look at now, because it's really a great opportunity to have a look at both sides and be able to improve the processes for both sides in one go.
Mm-hmm. It makes so much common sense, It's both looking at credit risk. So I would love that other regulators outside Australia would follow that example of APRA, because that's just, it's only logical that you address credit risk coming, from the same underlying data calculating for ECL as well as for the Basel view. Yeah, that's a very good point. Maybe something completely different.
Sorry to jump in.
Sure.
Maybe just from a slightly different angle, but a scenario we've come across quite a few times as well is the whole data strategy and data move to cloud. Lots of organizations, have been looking at how can they, transform their data estate and leverage of cloud infrastructure. And they need use cases, right? Lots of organizations struggling to kind of build a business case for cloud migration or standing up a data strategy in the cloud. And Basel has actually been a great use case and a great catalyst for those cloud strategies as well. When you're standing up a new risk engine, for example, that is microservices based, that is cloud native in technology, that can deal with lots of volumes of data in a short amount of time and can provide real-time insights and analytics. Using that as a business case and a driver to push workloads into the cloud and feeding data through a cloud strategy into those calculators is what we've observed as a great business case for the cloud strategy as well, as well as an uplift in the risk analytics that come through from implementing more advanced calculators in the cloud environment.
Yeah, it's also something that we observe in Europe, that almost all new projects are specifically, where the software is running in the cloud. It's probably the only positive outcome of the whole COVID misery of the last 2 years is that all firms have made major steps in adopting cloud-based technology. Now, Thomas, a totally different question is while both you and Kathy are very familiar with the big brand names in Basel IV and IFRS 9 programs. Why did you choose ElysianNxt as a partner?
Yeah, I can take that one, Chris. Look, when we started looking out for solutions for Basel, in particular, it was around the time that APRA came out with their quantitative impact study. So that's an approach they take, during the creation of the regulation to look at what's the impact of the rules they've set on the bank's capital position. So we effectively worked with a number of clients to get an early view of the quantitative impact of the new rules. And as part of the exercise, we wanted to work with an engine that had all of the APRA rules out of the box, that was cloud enabled and native, cost efficient and scalable to also use for wider calculations across liquidity, market risk, and wider credit risk. So it was actually quite a quick decision for us to use ElysianNxt, because I think it's one of the only, if not the only, solution out there that ticks all the boxes when it comes to what we wanted to achieve with our clients in a very short amount of time. And so as a proof point for that partnership, we deployed the ElysianNxt risk engine in a matter of weeks for clients to get their full portfolio, contract level data loaded, processed, mapped against the new regulation, and get the full kind of bottom-up approach of calculations done as part of the quantitative impact studies. And so that was for us, I guess, an eye-opener in terms of being able to achieve that with customers in such a short amount of time. That's one aspect of it. And the other aspect of it is that we also have a very complementary offering in terms of APRA reporting. And so, where RegCentric solution uses similar cloud native technology and microservices approach, we can use the output that come out of ElysianNxt and feed that straight through to the APRA returns and have that at a granular level. So that actually sets organizations up for success when it comes down to the granular data reporting requirements that are coming down the pipeline. As we mentioned, is a 5-year journey that APRA has embarked on, and we're excited to be able to use the Elysian platform as an advanced risk calculation and management engine, and then use our Reg 360 reporting engine for the disclosures, analytics, and reporting on top of those rich data sets that are coming through.
Mm-hmm. Yeah, thank you, Thomas. Now, talking about the 5 years plan of APRA, in Europe, the ECB, one of the reasons they said we're going to delay the implementation of Basel IV with 2 years was also the fact that they wanted to include some of the upcoming ESG requirements. Do you see something similar happening in Australia?
I guess EPRA has taken a bit of a different approach. But first of all, EPRA was already on a journey for quite a few years to establish what they've called unquestionably strong capital buffers. So the decision of EPRA to go ahead with the Basel IV credit risk changes was informed also by the fact that in Australia, we don't actually expect there to be significant or material changes to the capital ratios. When it comes to ESG, EPRA has taken a slightly different approach. So EPRA came out with a prudential practice guide, CPG 229, back in November last year. And EPRA has taken a very consultative approach, looking more at the qualitative aspects of managing climate risks in across the industries. So it's not just in banking, but also in insurance, for example, where those exposures to credit or exposures to climate-related risks are materializing. It's not just a future thing; it's happening today, and we're coming out of a period of extensive flooding in Australia, and we have had a 1 in 100-year event happening twice in the last decade alone. So there's definitely a lot of tangible reasons as to why organizations and financial institutions in particular are very keen to get to grips with managing their climate risk. But I think we are still a few steps away from integrating those climate risks or ESG metrics into the quantitative aspects of the Pillar 1. I think they're more going to be part of the Pillar 3, the disclosures. And from that perspective, I also don't see, I think that's the reason as to why EPRA has chosen to push ahead with Pillar 1 changes, noting that some of the Pillar 3 changes are also going to come in future years, which is where I think the ESG requirements will be integrated.
Interesting point. And as you say, unfortunately, ESG is not something that might happen, but it's happening already. Now, maybe for the viewers in Europe, what can they learn from what you've seen in the Australian market, knowing that they still have like 2.5 years for the compliance program? Any advice that maybe you, Kathy, or you, Thomas, can give them?
I think just going back to the theme of data, I think we've seen that starting the gap assessment early on and analyzing what are the critical data elements and the information that's needed for the regulation is very advantageous if you start early. And of course, in relation to that, having a full, good understanding and holistic understanding of how the regulation impacts the bank's portfolio is of absolute essential and necessary at the very beginning. So those two things, impact assessment and data gap analysis, start right away. Even if it's a few years in the future, drafts of the regulations are already here, and knowing and being prepared for all of these changes is really essential, because reporting is just at the tail end of the process, but filling in those unknowns now can take a lot longer. That might require re-looking at your different source systems, potentially revisiting new data sources, or coming up with ways to derive data from existing ones. So I think that process, even before you start looking at how to automate it using a solution or a software, I think that process is really very critical to start with. And at the same time, when you have a look at that process, you also realize the types of gaps you have in terms of capability, in terms of people. So you'd see, do you have the necessary expertise around Basel? Do you have the data owners who know the systems well enough to be able to provide that gap? And do you have enough people to actually do all of this process, but at the same time conduct BAU and then lead project work. So there's a lot of things that you need to consider also on the resourcing side, not just from data, but also on capability and people, essentially.
Mm-hmm.
So I think being well prepared now, even if it's 2.5 years, it's actually quite a short time when you think about all the work you need to do. So I think getting started right away on those 3 key things is one of the lessons learned that we are seeing.
Okay. Yeah. Very good point.
Yeah, look, I can add to that as well, Chris, that this is a transformational opportunity, and transformations take time. We talked about legacy infrastructure and legacy systems, the opportunity to combine data strategy with, or as part of the business case for improving the risk calculation environment, and moving from the traditional monolithic legacy environments to a more, future-ready, ad hoc, real-time, that was the word I was looking for. So moving away from the more monolithic systems towards a real-time credit risk calculation process that delivers, analytics and insights into business performance. They're all journeys. Lots of organizations have either had start-stop types of projects, or they're struggling with those in terms of achieving them in a short period of time. So having this delay is this huge opportunity to actually get things done right, and use this as an opportunity to really transform the risk function through applying future proof technologies. And one of the feedback we are getting here in Australia is that organizations that that they wish they had started earlier. So I guess that's then the lesson learned: start earlier, because when there are data gaps that need to be addressed, just the time it takes to get changes done upstream in source systems is basically prohibitive, considering the timeline that we're up against. So getting that early view of any gaps in data that needs to be plugged, and starting those remediation programs early really sets up the actual project for success.
Mm-hmm. Mm-hmm.
Yeah.
No,
Yeah.
that's very useful to know. So start ASAP, I would say.
Yeah.
Anything you wanted to add?
Yeah, I guess this is probably for all financial institutions who will be impacted by Basel, but I think the aspect of stress testing and simulation capability is really something organizations should already start having a look at, because that will have an impact on, of course, your business, but also the type of infrastructure you set up, because not all systems are capable of running things on the fly in real time and seeing the results right away. But we see more and more, especially with ESG, climate risk, and all sorts of simulation capabilities that you would want to include in your calculation to be able to be prepared for in the future, for regulatory requirements, for business requirements, but also for environmental requirements now. You would need to have like a strategic view of having a solution that can do more than just comply with regulation, but have the power to run simulations, stress testing of different scenarios. So you would really have a holistic view from different perspective of what can happen to your business, your portfolio, depending on different scenarios in the market. So I think that's something that sometimes is a bit like an afterthought. Everyone is focused on compliance, this is the deadline, but I think it's important to really prepare for that as well, because stress testing usually means running things in multiple scenarios quite quickly, ideally, so you can get the output right away. But if you set up an infrastructure and a process that's very much static and very much only works towards, say, end of the period, then you won't really have that flexibility in place, and you're kind of, as Thomas said, this is a great opportunity, so you kind of miss the opportunity to also include that in your design at the beginning.
That's a very good point, because The world, unfortunately, has not been stable for a couple of years. We've seen Corona. We've seen, unfortunately, what's happening on the inflation side. There's the war in Ukraine. So yeah, it gives a huge opportunity for European banks to say, let's look further than just being compliant, but build an infrastructure that is capable to deal with whatever is happening in the world. Thomas, Kathy, thank you very much for the very useful insights. For any viewers out there, if your firm is looking for a real-time, fast, and more cost-effective solution for your can deal with any change in either your business, the economy, or regulatory changes, ElysianNxt team and I are here to help. For any viewers in Australia, if you're looking for the ideal partner to help you navigating in whatever happening to the Australian regulatory landscape, you're in very capable hands with Thomas and Kathy and the rest of the RegCentric team. Thank you very much, and thank you for watching, and hope to see you next time. Thank you.
Thank you. Thank you, Chris.
Thanks, Chris. It was a pleasure to be here.
Yeah, thanks.